Hey, great to be here, Scott.
You know, I always feel like when you're with us, we're either in the storm or we're trying to figure out how long it's going to be until we see the sun start shining again. And I mentioned in the intro to you this call you made back in October when you were with us about what you expected to happen to especially higher valuation tech within the Nasdaq. Let's revisit that, and we can talk on the other side.
If the Nasdaq were to correct, the growth multiples were to correct to January 2020 levels, pre-COVID. In January 20, nobody thought that multiples were too low. We'd have about a 30% correction in the Nasdaq. So I think when you're looking at the distribution of probabilities, whether you're playing from home or whether you're doing this for a living, you need to leave open the possibility that as rates begin to move up, as the world normalizes, multiples are going to normalize.
I'm not sure. I mean, the shirt looks the same, although it looks like a hoodie this time. So some things change and some things stay the same. So we're down 22.5%, 22.5% from Nasdaq highs. You said 30. I mean, you know, that's close enough. Are we done?
Well, I'll tell you, I like my beard game better from last year, too. It's hard to believe that that was only October 19th, that we were here at Milken and that we had that conversation. But, Scott, 22% in the Nasdaq doesn't really tell the story. The internals of the Nasdaq, the growth stocks, as you well know, are down 50 to 80%. And so we've now retraced below that 5-year average that I referenced in October. Certainly when we were talking in October, I wasn't anticipating a war in Ukraine. We weren't anticipating the concerns around hyperinflation, energy inflation, food costs that we've now seen. So we've overshot the averages. And now I think is the time that whether you're playing from home or whether you're a professional investor, you have to find opportunities to buy. You know, it's notable that Berkshire, after having $7 billion in net sales in 2020 and 2021, has deployed over $50 billion in the first quarter of this year. They don't know, and I don't know, when the tradable bottom is in. But we do know that we're closer to it today than we were last October. And I think if you're an investor investing over a 1, 2, 3-year time horizon, find your best ideas and put money to work.
Well, you have to find opportunities to buy. Those are your direct words just now, because it's such a stark contrast to what Paul Tudor Jones told our network today. Quote, it's hard to find a worse environment than where we are right now for financial assets. You don't want to own stocks or bonds. What do you make of that?
Well, I'm a huge fan of Paul. I watched him this morning. I encourage everybody to go to Robinhood.org and donate. But, you know, if you think about the 4 things that Paul talked about, interest rates, the direction of inflation, the ongoing war, and the increasing concerns about slowing global growth, those are well known, right? So at some level, they're priced into the market. Do we have more to go? Paul doesn't know. I don't know. But it's more asymmetric to the upside today. I just listened to Jim and Steph talk about, you know, us being data dependent and looking at that CPI print on May 11th. I think inflation is already rolled over. I think there's already a tremendous amount of demand destruction occurring in the world. The Fed and what the Fed does in terms of rates over the course of the next 6 months will determine the path of multiples. I think it's at least even odds that that direction will be up from here because so much has come out of the market from a growth multiple perspective.
So more asymmetric to the upside. Does that imply in any way, I mean, do you have is your gut feel, is this like would that be a bear market rally or the start of something more longer lasting as we perhaps face peak inflation and, you know, the market anticipates and understands and can frankly come to grips with what the Fed is going to do in the meetings ahead?
Yeah. Well, it's a great question. I don't really know what a bear market rally is. You know, that's the domain of traders. What I can tell you is I try to find excellent companies that are going to compound capital and earnings or compound revenue and earnings over a long period of time. I want to buy them at fair prices. I think I'm buying them today at fair prices. And so if that is the case, and if it's also the case that we're going to live in a world with inflation around 3%, with rates around 2.5%, 3%, that is the world we've lived in for the last decade. And it's been pretty damn good for growth stocks and for markets generally. If you believe there's a new normal, if you believe we're going to persistently live in a world of hyperinflation and interest rates that are going to be 5 or 6%, then now is not the bottom. So you have to have an opinion on that. From my perspective, again, we already see growth rolling over. You know, the Fed hasn't really even raised rates. Tomorrow's my birthday, May 4th. They're going to give us a 50 basis point birthday present tomorrow. But the fact of the matter is the market is already pricing it in. The mortgage rate is now over 5.3%. We're already destroying demand for the purchase of new homes because people can afford less home today. We already see used car prices rolling over. That's part of the challenge for Carvana, for CarMax, et cetera. So we see evidence in the market that the components of CPI are already being impacted by the expected direction of rate.
You think the market's overdoing it on the expected direction of rates? Both markets, bonds and stocks.
I don't know. If I look at the 10-year today at 2.9, might the Fed, push us in that direction? I think that 2.5 to 3 makes sense to me. But anything above that, I don't think it's sustainable given the level of growth and given the level of economic vitality in the world. I mean, we're on the verge of a recession in Europe. China has dramatically slowed down. China accounts for almost 25% of economic growth, and there's been dramatic slowing, and we see slowing across the board in the U.S. That's why, people are concerned about fundamentals. We see single-digit growth out of a lot of internet companies. We're hearing talk of layoffs or hiring freezes out of companies. So when you start hearing all of this, when you start seeing used car prices come down, you have to wonder where we are. And I think Jim pointed it out well, that we may have, in fact, already peaked on inflation. And, if inflation comes back down below 4 by the end of the year, then I think we're going to be in a situation that is highly investable from here.
Jim, I want you to get in because, look, this view kind of matches with yours that you've articulated on this program, and I've tested you on it, and you have not wavered one bit, Jim Lebenthal. What do you have for Gerstner?
Well, so Brad, I'm glad to hear your thoughts. It's always nice to hear we're in sync. Here's what the other side of our thesis is saying. And smart people are out there saying the Fed doesn't care, that even if inflation does moderate, that the Fed is hell-bent for leather to raise rates. Look, I find it hard to believe, but I'd love to hear your thoughts on that. You heard me earlier, dual mandate. If they meet the mandate, why raise rates? But the other side is saying they're raising. And by raising,
well,
I'm sorry,
let's be clear. The Fed,
by raising, I mean to 3% in the near term on the Fed funds rate.
Well, Jim, let's be clear. The bond market is already there. Like, that's what the world is saying, that, the 10 years trading, between 2.9 and 3. So I think the surprise, has already been delivered to the market. The market understands we've gone from 1.6 a couple months ago to 2.9 on the 10-year. So I don't think that that's a surprise anymore out of the Fed. I think you would have to be well over 3 for that to be a surprise. And so to me, taking the other side of that argument, of course, you've heard me say on this show many times, it's all a distribution of probabilities. You have to leave open the possibility that inflation's going to run hotter and that rates are going to be even higher. I promise you, when we hear from the Fed tomorrow, on May 4th, they are going to be as hawkish as they've ever been. And the reason for that is because they don't want the market to back off from those rate expectations. But then we're going to get that May 11th CPI print. I believe we're going to see it lower month over month. I think that will happen again in June and happen again in July. I think we're going to see further signs of global slowing. And I expect by the end of summer to early fall, you'll hear from the Fed, right, that they've accomplished some of their goals with these rate hikes, 50, 50, 50, that inflation is starting to roll over, and now they're starting to think about the balance between growth and inflation. They certainly don't want to throw the economy into a deep recession. Remember, we just had our first quarter of negative real GDP. Right? So another quarter of negative real GDP, and we're already in recession territory.
Yeah. Let's do this, Brad. Sit tight. We're going to take a quick break. We'll be right back with Brad Gerstner. We're going to get inside the portfolio when we come back.